Good morning. Welcome. It's Thursday the 8th. Topping today's agenda, President Trump wants a bigger army. Wall Street has a housing crisis, and Samsung shows off its muscle in memory, Tom.
On the markets, it is risk-off across the equity markets, across the Asian benchmark, the MSCI Asia-Pacific currently down 0.8%. European stocks, after a lacklustre day by the close yesterday, currently pointing lower by 0.3%. US stocks, that was a mixed picture as well by the close, currently pointing lower by 0.3% on the S&P E-minis. The opening trade starts right now.
Good morning, everybody. This is the opening trade. It's just gone 7 o'clock here in London. Let's start the programme talking about the defence sector, shall we? We've been talking about it for a long time with regards to the Ukraine story, the European defence sector, expansion of it has been a big theme. Now it seems we're going to talk more about the US defence sector. And I'll tell it in a slightly linear fashion just because of what happened in session yesterday and then after hours. So in session, we got the negative news. We got, from a corporate perspective at least, from the perspective of these defence companies, we got the news from the Trump administration who's signing an executive order. He doesn't want US defence companies to spend quite so much on buybacks, on dividends and the like. He wants them to do more development and more manufacturing, basically, and he doesn't want to have to pay so much for all the defence supplies. Then after that clearly sent those stocks down, and that's what you see on your board right now, on the screen right now, those defence names down in session. Then after hours, he came out with the carrots, he came out with the positives, saying the wider context is he wants to spend a lot more on defence.
He got the order wrong, didn't he? Basically, because the signal is, I want a bigger military, I want a bigger army, I want a bigger air force, I want a bigger navy, I want a bigger space force, whatever it's going to be. What I don't want is shareholders to benefit from that. I want America to benefit from that. I want productive capacity to go up. I want the ability to be able to fight wars and have all the missiles and all the bits of kit that I necessarily need. And it's going to be really interesting to see whether Europe follows suit on this, because Europe is going through a massive ramp up as well. Should Rheinmetall be up as much as it is right now? Should dividends be flowing out of these defence companies to European and international shareholders? Is this going to be the trend going forward? If we're rearming, should shareholders benefit, or should the American, European people benefit?
And the numbers that we've seen and being reported by Bloomberg suggest that President Trump has a point in terms of the amount that's been returned in dividends and buybacks versus how much has been spent on R&D. And there is a gulf and there is a gap there in terms of how much has been spent on R&D. It does not match the amount that's been returned to shareholders. But this is also a reminder, it takes us to our next major piece on the agenda. It's also a reminder that this is an interventionist presidency.
Absolutely.
They've intervened in rare earths and minerals by investing in companies there. They've intervened in Intel by investing there. They're intervening in terms of trying to reshape the defence sector, the oil industry, of course, and what's happening with Venezuela, and now the real estate sector as well in terms of the role of private equity. This is a Trump administration that is willing to get involved in the markets, and that has huge ramifications for investors if they haven't already woken up to this. What is next in terms of the cost of living crisis as we lead up to the midterms in November as well, in terms of levers that he can pull?
It happens so fast. This is the thing. There's a great story, I can't remember, I think it's an FT story, talking about Venezuela. Val was flagging this to me. And basically people are nervous about going into Venezuela because they're worried that a tweet could change everything in a moment. And we've just seen two huge pieces of evidence of that.
Policy making happens quickly.
How do you invest in this kind of world, though?
Yeah.
When things shift under you so fast. Like, we're getting used to it, but I'm not sure you ever get used to it.
Yes, and the interesting, so the housing story that we're talking about here is President Trump saying that private equity institutional investors, he doesn't want them to be investing in certain types of housing in the States, sent Blackstone down. Lots of questions prompted by this. You know, is this policy going to stand up to lobbying from the sector? This is a sector that donates a lot of money to the Republican Party. What does that do to the mix? Is this a policy that'll ever see the light of day? But John Author's cast it in an interesting light. To your point, Tom, about this being a very interventionist presidency, he talks about the K-shaped economy and saying this is the real challenge for this administration, is trying to close that K. And if they feel that these kind of policies are one way that they can at least try to do that or make a noise about doing that ahead of the midterms, then that's something we'll see more of.
We know that the Republicans are sweating as they lead up to those midterms in November. We know that they're under pressure, and we know that cost of living is a key question they feel they have to answer, and that so far the US president has not been able to do that. So this is one way to address. He is aligned with Elizabeth Warren, by the way, on this issue around the role of private equity in the housing market. I think it's important to note as well, Blackstone putting out a statement saying our ownership of US single-family homes represents just 2% of our real estate assets under management. We have also been net sellers of homes over the last decade. Holdings are down more than than a fifth. So that's the response from Blackstone saying this is a smaller market for us anyway.
They bought a huge amount. That kind of 2008 period was when the sector went into this space in a very substantial fashion. Is there a read across to Europe? If you're a policymaker sitting here in Europe and you're watching this and watching the level of intervention that Trump is prepared to deliver on housing to solve a crisis which is represented in the States and here in Europe, in the UK, how far are you prepared to go? Yeah. Trump's pushing the boundaries again and again and again.
It's reshaping the right of politics, that's for sure. It's giving us populism and what that looks like. I wonder what the Venn diagram between the right of politics in the US and some of the more left-leaning politicians, I'm thinking Mamdani, what does the Venn diagram about their policies look like? Where do they overlap right now? Let's talk about tech. That's another area that the Trump administration has been keen to intervene in.
And potentially there's the inflationary effects as we look at electronic prices going up, something we discussed and something we heard from when it came to one of the senior executives at Samsung. So Samsung coming out with earnings and top line, these numbers are very, very strong. So more than tripling in the most recent quarter in terms of profits for Samsung. A lot of that is driven by what we've been discussing this week, which is the cost of memory. And SK Hynix benefited last year, Samsung playing a bit of a catch-up, and the share price rallies have been there. The cost of memory that is not expected to come down anytime soon, certainly not before 2027. Samsung really benefiting from that, whether it is things like NAND, but also their high bandwidth memory that they hope will be able to align and be fitted in with the Rubin chips that come through from Nvidia in the second half. And Nvidia has some news flow as well in terms of what they're thinking about the Chinese market.
Just before we leave Samsung, the share price has been epic so far this year.
Yes, year to date.
Year to date, it's up massively. And yes,
17%, and that's this year, not last year.
Yeah, this is 2026.
We're not wrong about the year.
To Tom's point, the numbers are incredibly strong, but the stock is down today. But Asia tech is down more broadly today, but it's after an incredible run-up.
Yeah.
So we could argue this profit-taking, given that it doubled in 2025.
Which takes us perhaps to the Nvidia story.
So the Nvidia story, and this is Reuters reporting that Nvidia is saying to its Chinese customers, if you want to take ownership of the H200, the most sophisticated chip that it can ship into the Chinese market, if they get full approval from the Trump administration, then we want full payment. And that arguably, according to the reporting, is because they're concerned about how Beijing will assess this. We've heard as well reporting in the last day or so that Beijing has said to its companies, hold off on buying those H200s. So there's all that kind of uncertainty. It's a little bit like a marriage of inconvenience for these two sides as they try to align. Clearly, Chinese companies want to get hold of these H200s. Clearly, Beijing is reticent about that. And now Nvidia saying, well, if you place an order, we want to make sure we get paid in full because of the uncertainty.
Tom was talking about Waitrose and was it Aldi yesterday? Should we talk about Tesco's?
Let's do that. Let's won't try and pivot from one to the other. I mean, Tesco sells some. They're probably having to pay more for memory chips as well, just like everybody else. Certainly, they've had their own tech issues. I know that's Marks & Spencer's. We'll come to that in a moment. Tesco, third quarter, like-for-like UK sales up by 3.9%. The estimate was 4.8%. So that looks a little bit light in terms of what they're delivering there. The UK like-for-like up by 3.2% because there is a non-UK element to this as well. But those UK sales, they're missing estimates. That seems like something that might weigh on the stock.
M&S is actually ahead of estimates, though there weren't many estimates. It's slightly ahead of the 4.56 at 4.99 in terms of the Q3 top line.
But not on food, shocker.
But food is where the weakness has come through, and that's been the area of strength recently, though M&S has done a lot to rebalance and get back on the front foot when it comes to everything else. But yeah, it does look as if it is the food area that is interesting. That translates into the Tesco numbers maybe as well, and that maybe speaks to a consumer that is struggling in the UK.
Yes, interesting. We'll delve deeper into those. We'll keep those in focus, of course, as we head towards the market open. That's still, 52 minutes away. Let's tell you what's coming up on the programme today. Ben Jones, Invesco Director of Macro Research. Plenty of macro topics to put under the microscope with Ben. We will also talk to Elder Olafsson, who's the CEO of the Greenland miner Amaroq. So we'll get into the Greenland story about the extent of the raw earths and the extent of the mineral wealth that exists there or doesn't, and how attractive that is and is not to international investors. And we'll get into that conversation. Of course, the geopolitics hanging over it. Helen Jewell will be with us, BlackRock International CIO for fundamental equities. We'll also talk to Lee Robinson, Altana Wealth founder and CIO. And this is a conversation about emerging market debt. It's been really newsworthy over the last couple of weeks or so because of Venezuela. Are there other opportunities in the emerging market debt space that we need to keep in focus?
We'll get more details in terms of inflation as well across the Eurozone, but also in Switzerland at 7:30 a.m. UK time. Swiss CPI, that will drop. We'll break that for you. We did see evidence, of course, of inflation when it comes to the ECB getting closer to that 2% target yesterday. At 9 a.m. UK time, the ECB 1- and 3-year CPI expectations expectations will come out as well. So kind of building on the picture around the trajectory for inflation in the Eurozone again, which is looking pretty comfortable for the ECB at this point. 1:30 p.m. UK time, we're going to get the US jobless claims numbers. We had the ADP print that came in a little softer than the estimates yesterday. So jobless claims later today. And we will also be hearing from the US Treasury Secretary Scott Bessent speaking later in the day. Guy.
OK, what else do we need to know this Thursday morning? The AI startup Anthropic is said to be raising a new round of funding that would value the company at $350 billion. Sources say the Claude chatbot developer is seeking to raise $10 billion in new money. We're told Singapore's sovereign wealth fund and Coty Management plan to lead the financing, with Microsoft and Nvidia also expected to participate. Over 1,000 companies in the United States have lined up to recoup their share of billions of dollars in duties paid so far since the introduction of the US tariff regime by President Trump. This as the Supreme Court prepares potentially to decide this Friday on the fate of most of President Trump's tariff package. The administration had collected, or has thus far collected, $133 billion in duties under the emergency authority as of December the 14th. And the Trump administration says it plans to control future sales of Venezuelan oil and hold the proceeds in US accounts. The statement from the Energy Secretary, Chris Wright, is the clearest signal yet regarding Washington's strategy to control Venezuela's most valuable resource. Separately, President Trump says Venezuela will buy, quote, only American-made products using revenue from the 50 million barrels of oil it is currently sending to the United States. What do we think about that?
Got to cut through the signal and the noise on this one, haven't you? Because we know about all the challenges around actually getting that oil out of the ground. Yes, there's the build-up that they need to ship, maybe 50 million. How far does that take you? You have the seizure of the two cargo ships, of course, yesterday by US forces with the assistance of the UK. Again, this is partly a domestic story, and it goes to this aspiration to get $50 a barrel on oil, again, according to some reporting, and that is the goal from the Trump administration. Potentially below that. We saw the refiners in the US rallying on this. Canadian oil falling, so there's that market impact as well.
It's interesting that this is all part of a longer-term push then to try and keep China out of the Western Hemisphere, perhaps, is according to some of our some takes on this, at least this morning, because they are looking to control this Venezuelan oil indefinitely.
OK, so I'm a US oil company. Do I want to go into Venezuela?
Yes, at what price? What's
the risk? How quickly could it change? These are long-term investments I'm making. Also, the lower oil price means that actually the US oil industry is going to be struggling more going forward from here. Good for consumers, bad for the oil patch. So there's lots of
That's another K, isn't it?
This. Yeah.
Another K shape that President Trump is having to balance.
But there's a lot of assumptions being made. What is the relationship between the US and Rodriguez right now and the Venezuelan? We don't know. What does that operating partnership look like? If there is a partnership, how does that work? What does that actually look like in practice? We've got so few details.
Well, they're seizing ships. They're basically saying, if you want to send oil anywhere, the only place you can send it is the United States. Otherwise, it's kind of, we'll capture the ship, it's sanctions. So basically, you're not sending it to China, you're sending it to the United States. All the oil is going to go to the United States.
And you're not reflagging as a Russian vessel, or we're chasing you all the way to the north of Scotland. Coming up on the programme, we will check in on European defence stocks at the open after Donald Trump said he would request a more than 50% increase in next year's military budget. Does that have read across into European defence names? We'll certainly have a look at those. Plus, we'll dig into the oil story with Washington planning on long-term control of Venezuelan supply. Up next, equity jitters following the latest Trump tweets. We will talk about markets, looking a little less sure of ourselves in terms of risk appetite this morning. We will delve into the details of that. If you have questions, if you want to get involved in any of these conversations, we do like to hear from you. IB plus BBTV Go is the function to use. This is Bloomberg.
Thursday the 8th. Good morning. How's the hangover? How's it going? How are you feeling this morning? I don't know. Not too clever, I would have thought, if you're in the equity markets. That was quite the party at the beginning of the year, wasn't it? Now we're beginning to suffer a little bit. Asia certainly is down pretty sharply. Looks like US futures are beginning to roll over as well. European futures are certainly negative. 42 minutes to go until the start of trading this morning here in Europe. Overnight, President Trump delivering, well, a barrage of tweets, what do we call them, posts these days, that have certainly shaken up the market, and that's what Europe has woken up to this morning. And US equity markets certainly feeling like they have a hangover this morning, Valerie Teitel.
No, it does feel like these geopolitical worries are starting to cause some jitters in the equity market, in the global equity market. We know that obviously geopolitics was a big theme of 2025. Defense spending was a big theme of 2025, and it's looking like we could have another repeat this year. So we're seeing equity markets have a bit of a wobble. There hasn't really been a lot of fresh catalysts. There wasn't really a lot of clear direction from the U.S. eco data yesterday, but we have seen some pretty interesting single stock swings to start the year. I do want to talk about what happened with Intel shares yesterday and connect this with the geopolitical story. They surged 11% yesterday on essentially no new news. It was the biggest percentage gainer in the S&P 500 yesterday by the close. Now, if you want to connect this to what perhaps could be happening, maybe there are some positioning out there and thinking that if there is an escalation in Taiwan, you want to be positioned long Intel into that. Now, obviously, that is a big call to make, right? But someone clearly was worried about that and thought that Intel was a good buy off the back of that. So keep an eye on how Intel and TSMC trade against each other. Maybe that will be a good barometer for worries about potential geopolitical jitters. We also had this tweet from Donald Trump talking about a $500 billion increase to the U.S. military budget.
Amazing.
Enormous. The biggest that the U.S. military budget would have ever seen, the biggest one-time increase. Yes, there's a lot of questions on whether he could actually get that through Congress. But again, this is another signal that defense stocks, the rally of 2025 is not yet over. We saw many defense names recoup some of their losses of yesterday and after-hours trade off the back of this tweet.
Valerie, thank you very much. Valerie Seisel with the latest on many of those market dynamics shaping our thinking over the past 24 hours. Let's stick with the markets. Traders weighing some of that mixed data out of the United States, all those geopolitical shifts that Valerie's been talking about, a flurry of demands from President Trump, executive orders and other, I was going to say requests. I'm not sure that's the right word on social media.
Polite requests.
Yeah, very. For more, let's speak to Ben Jones, Global Head of Research at Invesco Asset Management. Ben, really nice to speak to you. Thanks for coming in. How do you think about, as an investor, how do you shape your thinking with such an activist presidency? I mean, just in the last 24 hours, technology, housing, defence, executive orders, policy statements. How do you deal with the level of activism we're seeing here and intervention from the White House?
Sure. Yeah. Well, look, I certainly don't trade it on the minute-by-minute basis, as Valerie was saying a second ago. You're getting whipsawed around with very, very different news stories. What I try to do is take a bit of a step back and say, what are the key trends? Where is the direction going? And actually, over the course of the first few trading sessions of 2026, nothing has really changed in my core view. Everything actually is sort of taught to emphasise the views. We are going to see more defence spending. We are going to see a more activist president. Well, we knew that from 2025. Where does that leave us from a macro perspective? It leaves us with more inflation. It probably leaves us with better nominal growth as well around the world. We know that Europe is going to be looking more inward. It's going to be looking at more defence spending as well. We are going to see that reshoring. So again, the Intel story mentioned there. Well, we knew that the US wanted to reshore some of that production anyway. So these trends are only going to continue. And I think it's those ones that you want to latch onto because none of us are going to be smart enough to pick up what the next tweet or X or truth or whatever it is going to be. Don't react to that. But think about the big trends. I think
that's almost a comforting continuity message, Ben. Start 2026.
I try.
We're trying. So a more siloed world means more inflation, and these things are evident in a lot of the geopolitics we're talking about. So even if we don't draw lines directly from the geopolitics into day-to-day moves, that's the backdrop, is it?
That's the backdrop, exactly. Yeah.
And you can really invest around that then.
I think you can invest very well around that. I think actually that's a better investment backdrop for a lot of active investors than really it has been over the course of the last decade and a half or so. There are better opportunities in Europe, in Asia. It's not just all about the US anymore. And again, obviously, we know that last year the US was not the best performing market by quite a long way, actually. Much better performance in places like China and Korea, and even the UK outperformed the S&P 500 over the course of last year. I think those are the trends that are going to continue over the course of this year and probably into the coming years, and those are the themes that we're trying to pick up on.
Ben, is the UK a hedge to some extent around some of this volatility, the FTSE 100?
I think it is a little bit, from a lot of different perspectives. Yeah, I mean, it's a bit of an exposure to the commodities side of things as well. And again, depending on what you think there is going to happen with gold and silver, I think they're going to continue to rise. That's a good signal for the miners. The oil picture, I'm not actually sure that the Venezuela story has a massive impact on the oil picture in particular, but if you get a little bit of positivity from oil over the course of this year, just because we think that global growth is going to be better, that's potentially positive. But also, it is that market that is a little bit less sensitive to China, sort of moving up the value chain, for example. It's less exposed than Europe is, for example. It's also got great yield. It is a bit more of a defensive market, and that yield characteristic, I think, is really, really interesting. So we're starting to hearing a lot more interest in the UK equity market than we have for many, many years. And let's be honest, it's an unloved market. It is undervalued compared to many other markets.
Do you think it outperforms again this year?
I think it does, yes.
Interesting. We want to get your views on the labour market of the US, because we had the private payrolls, the ADPs, yesterday a little softer than expected. Of course, non-farm payrolls on Friday. Maybe that's why there's a bit of profit taking, if that's
Absolutely.
what it is today. But you're confident on the strength of the labour market. What are you seeing to give you that confidence?
Yeah, so I think my view of sort of the consensus, and that's a pretty hard thing to actually sort of really get a handle on, is that people expect the labour market to be pretty soft in 2026, and that to give the Fed some extra room to cut rates over the course of this year. Some of the data that I'm looking at suggests actually the labour market is potentially going to be stronger, and quite a bit stronger than many people are expecting. So if I look at things like the NFIB Small Business Survey, for example, over the last 6 months, more and more of those companies are saying, we want to increase hiring over the course of this year. We're struggling to find the workers that we need. And obviously, there's a big immigration story around this, of course. But historically, if we go back, and we can go back to the 1980s with this data and say, when we've seen that kind of move in that indicator, what typically happens to unemployment over the next year or so? And it typically falls by about half a percentage point, 50 basis points. That's a meaningful drop. And I don't think many people are looking for that kind of strength in the labour market. Now, again, if that comes to pass, even if that doesn't quite come to pass, but it kind of comes to pass more or less, it's back to the inflation point. We're going to get sort of higher pressure on wages, more inflation.
More inflation means rate hikes?
I don't think it means rate hikes
Why not?
I mean, if I was sitting in the Fed chair, I would probably say that rate hikes should be on the table from an economic perspective, but I think you've got to throw a lot of your rules out of the out of the door at the moment. We're going to get a new Fed chair.
Does the bull market, but the bull market's going, look, you shouldn't be cutting rates right now.
Absolutely. And if we go back to September 2024, when the Fed first started cutting rates, we've had 150 basis points of cuts since then. Yeah. Where are 10-year yields? They're up on the back of that.
Do you think they go higher from here?
I think they probably...
We're near 4 now. Do you think we go back towards 5?
I think we head up.
In the US?
In the US, I think we head towards that zero. So I would not be taking duration risk in the US at the moment. So I think we get some rate cuts, but I think we get bond yields creeping a little bit higher. Not a bond riot, not an explosion in yields, but a gradual creep higher. So I think it's more about being very selective in the bond market. It's not about buying duration right now.
Ben, thank you very much indeed. Ben Jones, Global Head of Research at Invesco Asset Management. We have some breaking news right now, and it involves Nvidia and H200s, and a decision, according to the Bloomberg Scoop, that China will be approving Nvidia's H200 AI accelerators and the purchases as soon as this quarter. We know the Trump administration has signalled that they are willing to allow those chips into the Chinese market. We know that Jensen Huang of Nvidia has said that they are producing them, they've got production, and they're seeing strong demand from Chinese customers. And now we have Bloomberg reporting suggesting that China will approve those purchases as soon as this quarter.
Nasdaq's trying to bounce on the back of this. It was heading down after the Asian session. It looks like it's beginning to try and pop a little bit higher on the back of that. So that could have an impact into the European start of trading in 33 minutes' time. What are we going to be talking about next? We're going to take you to Greenland. Critical minerals, a key factor behind the Trump administration's desire to acquire the island. We are going to speak to the CEO of mining company Amarok. We'll figure out exactly what's there and what could be there next. This is Bloomberg.
Welcome back. This is the opening trade, Thursday, the 8th of January. And the futures picture looks a little challenged if you're long of these equity markets. So equity market futures for Europe down a little bit today. We've been talking a lot this morning with Valerie already about the reasons for the market weakness yesterday. There was a lot of activity from the White House, shall we say, around various sectors in the United States yesterday that perhaps was weighing on those, whether it was defence, whether it was the real estate investment story. All of that taking the edge off risk appetite perhaps a little bit. bit. Perhaps the geopolitics taking an edge off as well. We talked a little bit about that with Val as well. So that's the equity market story as it was yesterday. Into the Asia session, again, a little lack of appetite for some of the technology names and these Nvidia lines that keep coming thick and fast about what Nvidia is asking of its Chinese customers and what the Chinese are allowing Nvidia to do. They're sort of setting the tone, Guy, it would seem, for the futures picture. Futures trying to bounce a little bit on those latest lines we had.
Bonds are catching a bid, unless you're French, which are absolutely flat, the OAT market. So a little bit of a bid into the bond market. You're seeing the same thing in treasuries. We're 413 over in the United States. Swiss CPI is a little better. Last time around it was 0 CPI year on year. Now we've got a 0.1. Woohoo. And that's kind of where we are. But actually, the fact that it's getting a little bit better actually maybe reinforces the idea that the S&P maybe doesn't have to do much more at this point.
More broadly, if we're going to linger on the subject of inflation for a moment, I thought it was really interesting, the conversation with Ben, saying, OK, so it's easy as investors to say these geopolitical lines, we look through them, they don't impact our day-to-day. But he was echoing what we've heard from a number of other investors, that a more regionalised, more siloed world is a more inflationary world, and that is something that maybe they can invest around. And all of the basic resource stories we've been talking about tie into that.
I'm interested to see how gilts react this morning to what I think has been some quite grim news out of the UK retail sector this morning. Tesco, Marks and Spencer, I don't think the news is that good. AB Foods, the news out this morning on Primark is not good. It's going to be interesting to see how that stock opens up this morning. It paints a picture of a fairly depressed UK consumer, and I just wonder whether that will be something the Bank of England will just be kind of cognizant of.
Gilts rallied yesterday.
Yeah, they quite a big move yesterday.
Yeah, does that continue as we start to price in more cuts from the Bank of England? Let's get to the resources story then, and how that ties into to inflation and the pickup they're seeing across commodities. Commodities today in the session under a bit of pressure, but of course to start the year they have gained pretty significantly. US Secretary of State Marco Rubio says he plans to meet with Danish officials next week after the White House doubled down on President Trump's intention to take over Greenland. This is how it ties in, because there are, of course, commodities in Greenland. Meanwhile, the Danish Parliament's Foreign Policy Committee Vice Chair, Todd Bloomberg, he hopes cooler heads will prevail.
Some common sense must be applied. We've been a partner with the US for more than 80 years. We have helped them in Afghanistan and in Iraq, and one NATO country doesn't go and require territory of another NATO country. It's unheard of, and it's disrespectful.
Let's bring in Bloomberg's Son of Us now from Copenhagen. Sana, what can Denmark potentially, and Greenland, put on the table that could assuage President Trump, that could address some of these concerns, that could dial back some of these tensions?
Yeah, good morning. Danish and Greenlandic officials, they are really hoping that this meeting can help clarify things. It is the first time since Trump took office that both Greenland and Denmark are meeting Rubio together in order to actually discuss a way forward. Officials here, they essentially hope to dismantle the argument that Trump uses when he talks about the U.S. needing control over Greenland. They believe that the U.S. has been painting an incorrect picture about the situation in Greenland, and that the U.S. has misread the situation. For example, Trump has stated that Chinese and Russian ships are everywhere around Greenland. Denmark says that's wrong. Trump, he's also criticized Denmark, saying that they've not invested in Greenland's defenses. Denmark says that's wrong too. So they're really banking on this meeting to kind of start a diplomatic route out of this conflict.
Yes, the use of rhetoric and logical argument then to push back here. We'll see if that delivers. How have businesses, Sana, been reacting here? This is businesses either in Denmark or in Greenland. How have businesses been responding to this quick escalation of events?
Yeah, I mean, there's a lot of uncertainty at the moment, especially for Greenlandic businesses, and that's just not good for business. So Greenland's companies say it's difficult to plan ahead, so they are putting decisions on hold and kind of waiting to see how things play out. Some people are also seeing opportunities from the situation, potentially to expand to new markets in the US. Greenland's economy is under strain, so any kind of new business opportunities are very welcomed here. Greenland has been clear all along, we are not for sale, but we're open to business. And now we're hearing from sources in the US that officials there, they're rushing to come up with options for kind of business deals and other ways for the US to step up links with Greenland, that potential alternatives to military force. It will be interesting to see what comes out of that. One big challenge for Greenland and especially its mining sector is that it's been very difficult to attract investments because of the very difficult infrastructure and unreliable weather. The hope is perhaps that the political focus on Greenland could help to change this. But I'd say Trump's very aggressive rhetoric, it's not necessarily a good starting point for entering into any deals. So for now, the most important thing for companies is this conflict needs to de-escalate, and then we can start talking about next steps.
Sanna, thanks very much indeed. Son of Us joining us out of Copenhagen. I don't think Trump can change the weather, but maybe that would be helpful as well. Let's stay in Greenland, where the weather, I imagine at this time of the year, isn't that clement. Our next guest, largest private investor on the island, mining portfolio. It's got critical minerals, precious metals. Amaroq's main asset is a gold mine in the southern part of Greenland. It's also got exploration licenses for copper, rare earths, minerals, these kinds of things. Elder Olafsson is the CEO of the business and joins us around the table. How does he feel about Donald Trump this morning? Friend or foe? Has it changed? Like, beginning of the year has been a bit crazy. How do you see it? Do you see the situation changing dramatically?
Like, if we take the past 10 years, I mean, in 2017 he made the first claim that he was interested in Greenland, and he really put Greenland on the map. People saw, well, there are resources there. It's a good jurisdiction. It's a Nordic country. For now, you're right. He then obviously went away, Biden came in, and so things relaxed. Now he came straight into power a year ago. He did the same thing that he just mentioned now, and now he's repeating that. Because he doesn't want, I think, lose time to get something done there. And I think that overall is a good thing, because Greenland needs investment, like Sanna was saying. And we as a company, we have Danish investors, we have US investors. We've just opened up the company in May for those two investor groups. And that has been a great support for people to understand that the minerals and the processes.
Has there been a pickup in interest from American investors?
Yes.
So this is having a positive effect on your business?
Correct, yes. And so we've managed to raise more than $300 million over our 10 years there. As I said earlier, we developed the first gold mine. That's in production. We are now developing a zinc, lead, silver, germanium and gallium mine, which is really important to the US, especially the germanium and gallium. Which has ties to Landry, their special envoy, who's setting up a germanium and gallium processing plant in Louisiana. So this is really, really important that both the Nordic and the US works combined with Greenland. And it's in the end Greenland who takes a decision. We are a Greenlandic company. We work for their interest. But you will need both of these interests to align to make it work there, for sure.
Are you an acquisition target at this point?
We certainly are the only operator who has developed a mine. We have 300 people working for us. We have rigs, mining equipment. We have good cooperation with government. So yes, we are the player in country that can do things, and we intend to leverage on that.
What are the major roadblocks? We talk about the infrastructure, the weather. What do you need to expand your operations? What's holding you back from going further and deeper and producing more and getting it to market?
Yeah, no, it's a good point. Like, I mean, the key here in Greenland, like, if Greenland was so great, then it would already be developed. So what is great in Greenland? It has high content of minerals per square meter. It's high in the crust. It has a great jurisdiction. But the question is, how do you take it out? How do you fly in and out? So there's a reason that Amaroq has an office in Iceland. There's a reason we fly everybody via Iceland into Greenland. In Iceland, you have processing capability, you have flight routes, you have airports. There's a reason why the Second World War, Americans built up army bases in Iceland and in Greenland. All of this is connected to logistics. So understanding logistics, understanding how you move people in, not only money, but people in, product out, and how you do all of that. Once you crack that nut, you know that this is the best resource base that you can find in the world, we think.
I mean, you've set out some of the positives then that the Trump administration's attention on Greenland is doing for the investment climate. Are there negatives around the way that this conversation is happening or the mood it creates on the ground? I mean, you're more familiar than we are, for sure. You're very connected with the population on the ground then, with all those employees there. Yeah. Are there negatives around this?
I think like the reality when I'm in Nalunaq, our mine, or in Black Angel, our mine, it's not like what are you going to invade? Right? There's just a camp there, and who are you going to threaten? So I think the reality of life, I don't think people are really frightened about it. People don't like the rhetoric or the language. But my argument to the Greenlandic people, and I have cousins and nephews in Greenland, so we're really much tied to it, is that Greenland is now in the position to decide its future, to build up its economical independence. Amaroq will be the largest taxpayer in 2027. Yeah. When Black Angel, zinc, lead, silver, germanium, gallium mine is in production in 27, they will be becoming more and more economically independent. So what my point is that there is opportunity in this. I'll give you one simple example. In 2006 in Iceland, the US Army left to focus on Middle East. In 2007, we had the biggest banking collapse in Iceland because we didn't have the support of US any longer. So having that support of the Nordics and US does matter. OK, so and you seem quite positive then about some of the investment drivers that could result from this. Does all of this end then with the US having more access to the minerals in Greenland in exchange for the security umbrella that it provides? Is that how we shortcut to the end of this conversation? Yeah, so I think what needs to happen is that the area of influence for US needs to be strengthened. So the defense agreement potentially needs updating. Investment agreements between US and Greenland, meaning free trade agreement, and Iceland, by the way. Denmark is putting in a lot of capital, like Susanne said, and they are stepping up investment in defense and in minerals, and they're doing that really, really well. So in the end, between the Nordics, Denmark, and US, this is a combination to make Greenland independent, to allow them to run their own country. And I think you see that in the rhetoric from Landry and from Rubio. That is what the aim is and the ambition is. And by the way, there is an example of this in Iceland. We became independent in 1944 with the help of US and Denmark. And today we run one of the strongest economies in Europe, and we're the gatekeeper of the Atlantic towards the UK and US. Does it feel Nordic or does it feel? It feels Nordic. I mean, okay. Iceland inhabited Greenland 1,000 years ago. So this is by historical standards, this is quite a Nordic country. Yeah. How would it change if it was American? I think similarly, I don't think you will see so much massive difference. So Iceland sits on this boundary between America and Europe, physically. Like we have two plates coming together. And we are very much American and we're very much Nordic, right? And so I think you see exactly the same in Greenland. So this is, geographically, you have to be both. You have the interest in both nations. You need the logistics to work. Do you understand Trump's desire to own it? Yes. Why do you think? Do you think it's because of the minerals, or do you think it's because of something else? I think it's mainly due to three things. I think it's due to defense. Yep. You just see it right now when the ship was captured, or the Russian ship. This was done next to Iceland. The fighter just came to Iceland and via Greenland, right? So that is clearly something that he's concerned about. It's about the mineral resources, for sure, and it's about shipping routes, right? So those three things are extremely important, and he wants to make sure that. Do you understand Denmark pushing back? Do you understand why that? Of course, of course, and Denmark and Nordics and so on are pushing back because we are all in the Nordics. We're a Nordic family. It's a stronger union than actually the European Union, which Denmark is part of, the Nordic Union. We have the same inheritance, same background, and so on. So obviously we are going to back Greenlanders. And Denmark has said Greenland needs to decide what they want to do. We've said that in Iceland, and I think now the politicians in the US are saying exactly the same. Elder, thanks for stopping by. Next time you're in London, come and see us and update us on how it's all going. Elder Olafsson, Amaroq's CEO, the latest on Greenland. Coming up, staying with the theme, President Trump is demanding more defence spending and threatening to cut out companies that do not comply.
President Trump is saying that he wants to see defense companies building new plants, building new factories, delivering on time, and then maintaining systems cost effectively. And that's, trying to do more of that is why I started Anduril 8 years ago, because I looked at the United States defense industrial base and realized we weren't moving fast enough. We weren't building new plants. We weren't building the new technologies that we needed. And so I'd say I'm broadly aligned.
Are European stocks going to be broadly aligned? We're going to check out defence stocks as we run you towards the market open. 14 minutes away. This is Bloomberg.
This is the opening trade, 7:49 here in London. 10 minutes then till the start of the equity trading session for this Thursday morning. Let's bring into the conversation Bloomberg Markets Live, Skylar Montgomery-Koenig for 3 minutes on the market. Skylar, good morning to you. So we seem to have lost risk appetite somewhere along the way. The start of the year was really good, and then it just faded over the last day or so. Is it because of some of the geopolitical headlines sort of piling up on top of each other? Is it the US data? Is it something in the technology space? What is it for you that's sort of weighing on sentiment?
Yeah, I think we have all of these cross currents right now, so it's quite hard. I would admittedly say that I think heading into big US data on Friday, people are maybe more cautious. I'm less worried about geopolitics. I think what you tend to see is geopolitics is there's an immediate market reaction that tends to be risk off. Then when the worst case scenario doesn't happen, you return to trading fundamentals, which right now are quite positive. And so I think the reason you get that kind of reaction is because geopolitics is very, very hard to price. It's a kind of low probability, high impact event. So, for example, if you have a nuclear war, that means that asset markets are essentially worthless. So how do you price that? And so the market just ignores it unless there's real policy change. And we are starting to see some of those policy changes. So I would watch that more closely than I would watch kind of headlines around Venezuela or that sort of thing.
But policy's beginning. I hear what you're saying about geopolitics, but what we saw overnight was policy.
Yeah.
So is Trump getting in? Trump is now delivering policy changes, quite big policy changes, and the market keeps getting wrong-footed by them. How do I price in policy? How do I price in volatility in policy changes? Is a question.
Absolutely. I think right now what you're seeing is that volatility is relatively low.
Really
so
low.
Hedges are good to look at right now, especially because you don't know what exactly is coming in terms of specific policies affect specific markets relative to your headline number. The other thing I think about is that geopolitics generally feeds into the market through commodity prices. And so what we've seen in recent history is that Red Sea disruptions, Russian invasion of Ukraine, as oil prices and energy go higher, and that's a stagflationary shock, which both bonds and equities do poorly in. So it's worth considering having commodities in your portfolio, real assets more generally like gold as a hedge to that.
Is AI inflationary because of all the inputs around energy and chips and data centers and supply chains, or is it deflationary as the model costs come down? How are you thinking about AI tech?
Yeah, I think it's both of those, but what I think dominates is the inflationary impact. So what you've seen in previous periods of technological advancement is, this is also why I'm not necessarily worried about the end of the tech trade, is that we're entering this new phase where you see, yes, costs come down, so that allows widespread adoption, but it also allows productivity to be higher, growth to be higher, and returns on capital to be higher. And so that environment, to me, where you have higher demand is pretty inflationary. It's also an environment where you have stronger equity returns in the intervening periods, and it's also very important who's driving those tech advancements. And so in those periods, you tend to see U.S. equities gain or outperform other markets because the U.S. has led the tech revolutions in recent decades. Okay, adoption and productivity gains, and those are still things that we'll continue to monitor. Skylar, thank you very much indeed. With that take on the markets, Bloomberg M-Live, Skylar Montgomery-Koenig, of course, Montgomery-Koenig. Let's get our stocks to watch now with Chloe Mellet. Chloe.
Good morning, Tom. So let's start with defense stocks today, which could be on the move after Trump said that he intends to really increase the U.S. military budget. And we're not talking about a small increase. He's talking about a more than 50% boost in defense spending. And so we could see that reflected in the shares across Europe this morning. We have seen Asian defense stocks move higher on the back of that already. And so we could be seeing similar movements there today. And this is also worth noting that the continued tensions in Venezuela are also are also contributing to that jump in the defense trade. Moving on to Henkel, and we have got some shampoo M&A. So Henkel over in Germany is said to have submitted a takeover offer for Olaplex, the shampoo maker, and this is something that really boosted the shares of Olaplex over in the US, and so we should keep an eye today on how Henkel shares react. As we can see, there has been quite a lot of weakness in that stock over the last few months, but perhaps news about this potential deal will provide that boost. And finally, let's go over to Recruiters, which could be having quite a tough morning this morning. So we have got Randstad, Hayes and Adecco all downgraded by Jefferies analysts this morning, and so we could see that reflected in those shares. Today, the analysts have said that cyclical headwinds will be exacerbated by new structural challenges, and that should really keep a lid on earnings, and so therefore we could see a bit of weakness in those names today.
Chloe, thank you. Chloe Melly from our equities team, of course. I'll throw into the mix, and there's plenty there that Chloe was going through that we need to watch. Lots of other stocks in focus as well. UBS, a compromise plan this is around their capital requirements, has got the backing of the largest Swiss party. Does this increase the chance that something that's more favourable to UBS comes out of this whole political drama there?
Sergio Ermotti, of course, who leads UBS, has been on the front foot in terms of making that case, and there have been the threats, not made by Sergio directly, that they could look to move their headquarters. Of course, Sergio's downplayed that when you've spoken to him, but he has been pretty assertive in making the case that these capital requirements would be highly restrictive on UBS and make them far less competitive.
Okay, it's still going to be
their US counterparts.
It's going to be better, but still tough, I think. It's not the extreme that we were talking about, so there are ways round some of these solutions, but as the market, how much is the market priced in? Anyway, 5 minutes to go until the start of trading here in Europe. Looks like the early year party beginning to fade a little bit here in Europe. We'll talk about the open in just a moment. This is Bloomberg. Thursday morning, good morning. The traffic around the Arc de Triomphe can be bad on the best of days. Today I wonder just how much worse it could be. This is a live shot coming to you from Paris, the Arc de Triomphe. French farmers are protesting their views, or protesting against the government on Mercosur, the deal that could be done with South America. Keep an eye on this one again. This kind of speaks to what is happening in terms of geopolitics and the impact they can have on global markets. French farmers not happy. Let's talk about where markets are, because to be honest, equity markets aren't happy either. The S&P yesterday rolling over quite sharply into the end of the session. Number of policy factors in the mix there. What is happening with housing and Wall Street's housing crisis. You've also got the defence stock story that we're watching as well. That changed quite significantly overnight. But basically, Europe went out here, the market closed down there, and Tom, that points to maybe a negative start here in Europe this morning.
It does, and you saw that bloodletting in the Asian session as well. A lot of selling coming through. The Kospi a little bit more immune to some of that, thanks to the gains coming through for Samsung in terms of the earnings picture, even if that stock was down a little bit. So we continue to watch tech. We continue to watch basic resources, commodities under a bit of pressure. The retailers here in the UK as well, on the back of some updates from M&S and Tesco. So European futures coming lower down, 0.2% is the flag. FTSE 100 futures probably low by 42 points. Over in Germany, the DAX looking to drop just 0.1%, Anna.
Yeah, interesting to see that difference between the DAX and the FTSE. Let's have a look at where we are on individual stocks we're watching and sectors. Defence in focus. This after the flurry of announcements from President Trump, his administration. Will some of that catch on here in Europe? Will it mean that Europe spends more on European defence names? We will certainly have to focus on that. UK grocers in focus. We've had Marks and Spencer's, Tesco out with numbers, AB Foods with a gloomy take on Primark. Shell also in focus, signalling weak oil trading to cap a pretty rocky year at that business. So we'll keep that one in focus as well. Guy.
OK, let's talk about how that all translates into the actual numbers. We are expecting a softer start to the session here in Europe. Beginning of the year was quite sensational. Amazing performances, particularly being driven out of Asia. That's beginning to fade as well. FTSE 100 absolutely flat. I'm interested to see how Tesco trades. I'm interested to see how AB Food trades, how the oil market trades this morning. There's lots of things to roll in to the FTSE 100 today, and we start to roll over a little bit. There you go. Look at that. Down by nearly 0.5% now. Stock 600 we'll get a little bit more clarity when some of these other markets open in just a moment. Defence stocks, I think, are going to be absolutely fascinating today out of Europe. A, is Europe going to have to spend more? The US potentially is going to be spending more. And B, are we going to be getting dividends out of these companies going forward from here? The CAC is down by 0.3%. The IBEX is down by 0.3%. The FTSE is now down by 0.5%, gathering pace to the downside. But remember, it was an incredible year last year for the FTSE 100. Look at that number, 9997. That tells you kind of where we are. We're at the 10,000 level on the FTSE 100, which in some people's minds is extraordinary at the moment, but that's beginning to fade a little bit, back to 10,000 now, but still down by 0.5%. We need to dig into the details. We need to find out what's happening below the surface. Tom, what are you seeing?
I think the FTSE 100, actually, if you lift the lid, tells a lot of the story across the theme today, because defence stocks are up, but on the downside, it is the retailers, and it is the names like Tesco and Sainsbury, of course, but also the miners, as we expected, given the pressure on commodities, at least in the session today. Across your other sectors more broadly across Europe, utilities, so that defensive move up just 0.1%, insurance modestly gaining as well. 3 sectors so far just in positive territory, the rest on the downside. Personal consumption as a sector is down 1.3%. Financials, basic resources, there's the mining pressure down 0.6%. Energy also a little softer by 0.5. Anna.
Yeah, and in that energy space, that's another leg to the FTSE negativity, because Shell is one of the biggest fallers or the biggest faller in the energy space. So that's down by 1.5%. And we had that update, the trading update from Shell coming through. But it is the grocery store story that is dominating the downside, isn't it? Tesco down by more than 4% now, as you said, Tom. Sainsbury's also weaker. So if you're looking for the standout negative sector, that's where you find it. And only 3 sectors in positive.
Is that a macro story as well? I just wonder whether or not this is something the Bank of England is going to be thinking about when you think about how weak the consumer is in the UK at the moment.
Well, there was a lot of focus on Black Friday being really weak, and people said, well, the budget was late, and so that delayed spending there. Then the thinking was maybe that pushes it into Christmas and you have a good Christmas. Well, if that's not been the case, if that's not what has happened, then that maybe is new information for the market to deal with. And certainly on the Tesco side of things, that seems to be where the downside pressure is coming through this morning. Let's speak to Helen Jewell, shall we? International CIO of Fundamental Equities at BlackRock. Helen, very good morning to you.
Good morning, Anna.
It seems like a lot of news flow hitting us just this morning, the last 24 hours, plenty to deal with. As you look ahead into 2026, stepping back from all of this, what's your big picture outlook, your big picture thesis?
Yeah, I mean, it's a really interesting start to the year, as if you already kind of flagged there. A lot of markets are starting at real highs. I think there's 2 things that we are super focused on this year. The first is in terms of the broadening out of the market, and in terms of the broadening out of things like the AI theme. We're already starting to see that coming through. We're seeing it coming through in terms of spend on chips already, hardware, energy, infrastructure, and of course the materials names. So that is the first area. The second area, I think, is something we probably didn't talk about quite as much as we should have done in 2025, and that is back to basics when it goes to things like inflation, when it goes to interest rates, and exactly what are the interest rate cuts and how might they come through, and what are the potential inflation pressures, and what will that mean in terms of actual growth numbers. What's interesting in the US, you've actually seen some good growth numbers come out for Q3, and not all of it is being driven by AI, as you just talked about in the UK. Whilst you've got some of the today's story is not so good, we did have Next recently actually on a more positive side. So in some ways, I think we need to remember, for all of the headlines, for all of the geopolitics, what the markets get driven by, earnings and some of the macro pressures that link to that.
OK, and so we talked to Ben Jones earlier on the programme, and he was saying inflation is therefore a focus, because dealing with all of this geopolitics, a more siloed world, more leads to more inflation in his mind. And he said that is a very investable environment, and you're putting the focus back on interest rates and how that works. So what is the strategy then for 2026 with that in mind?
Well, the key thing with inflation is that it's not an area that you have a very direct kind of it's here and done trade. With AI, I think last year it was very much focused on a kind of a much more small subset. When it comes to inflation, I think the good thing from an investor perspective is there are so many pockets that you can actually play that along. We still remain, for example, overweight the European banks. European banks is an area that benefits obviously from interest rates not actually being cut, and if anything, there is more risk now to the upside than we had seen previously. It's not just about, by the way, the interest rate story. The European banks is also about the amount of capital they have and about the loan growth in Europe. But the breadth of names that actually allows you to have an investment view on is much broader, and it is much less country specific. It is much broader as well from different countries as well. So how we're thinking about positioning, we still remain overweight European banks. We also think that quality will return. Quality significantly underperformed, but actually we see that could be an interesting play as we move in. Those valuations now look much more compelling. So there's much more pockets that we can play this. So quality is an area that we remain focused on. We remain focused on sustainable energy and renewable energy, as the need for AI, and we remain very focused on European banks.
Defence stocks. Good morning, Helen. Defence
stocks
performing well in the session today, and of course they had a very strong run-up last year as well. And we have the news from Donald Trump that he wants to see a more than $500 billion addition to the defence budget, and we'll see if that actually comes to pass. What is the potential catalytic effect of that for European defence stocks? Is this a rational response that we're seeing today, and do European governments have to step up to try and meet that kind of spend?
BAE's up 6.3%.
Yeah.
You know, some of these names are really doing well.
No, absolutely. I mean, I think that's what we will need. For all of the kind of headlines about dividends and any, it's not about that. It's about what will the actual spend and the requirement to spend be for these names. We saw that a lot in 2025 as well. Obviously, the huge commitment from the German government and the Europeans as a whole in order to kind of commit to the defence spending. What we've seen at the start of this year, both in terms of the rhetoric and in terms of geopolitical issues, is that has got to come through. That is not just a headline, that is actual real numbers. So defence remains an area that we remain very focused on.
Do you think there is a risk to dividends and buybacks and capital returns? A European government's going to look at the Trump playbook and think, that makes sense?
I don't think so. I mean, the thing with the defence names is that is not the kind of main reason for the investing in them. The main reason is the earnings spend. So even if there was a rhetoric around that, I don't think it would impact in terms of exactly what would happen in terms of those stocks. The things actually, Tom, that makes me most nervous, or from an investment perspective, where we're less overweight than, say, the European banks, is the valuations are more full. So European banks, although they had a great year last year, still versus long-term average, are still trading actually in a very interesting range, and they have up to 25% return to capital in the next kind of few years in terms of market cap. That doesn't exist for the defence names, but that's not the reason for the investment. That is much more the earnings story. So we're not as overweight, but it is an area that we still remain very focused on.
What's the bond market telling you at the moment?
Well, the bond market is interesting. The bond market is definitely saying price and interest rate cuts are not as nearly baked in as they were 2 months, 3 months ago. That is the key thing. And I think that is what's going to be interesting as well for both the quality and growth trade that we saw last year. And again, particularly in Europe, they underperformed. Quality growth was a big underperformer. But secondly, what I'm really interested in, and something that you were very interested in last year, is the dollar. What does this potentially mean for the dollar if you start to see interest rate cuts coming through in the US and the ECB not cutting? I mean, that's going to be quite interesting. That would be a real headwind for the European exporters, which is, on the whole, those quality growth names. So the bond market is telling us to be a little bit more thoughtful about the interest rate cuts. I think we were probably a bit gung-ho about that last year.
Do you worry that the US economy potentially is slowing down at a time when it's running 6% deficits?
When you ask a question like that, I always feel like I have to say yes, because you think if you say no, it makes it sound like we're not worried about everything, and investors are worried about everything in the market. It's not something that we are super focused on at the moment. It's not impacting how we're positioned in portfolios, and it's not impacting how we are thinking about our
What's driving growth in America at the moment?
Well, it's interesting because the AI story is what we all thought it was, but actually the recent numbers suggest it's not just about the AI story, and the AI story is only a small part of that. I actually think there is a real strength in the underlying US consumer that we are not talking enough about. There is certainly the lower-end consumer that I think across the globe is something we need to be worried about. But the other thing we probably don't talk enough about is the circularity of the wealth effect. When you have markets at these all-time highs, and you have the US where a large number of wealth, much higher than in Europe.
It's tied up in the stock market.
Exactly.
So what happens if the stock market rolls over?
If the stock market rolls over, it's bad news all round.
So
that's can be categorically.
But it's
the sideways is okay. I mean, look at the numbers we're at. When we were at all-time highs, markets last year were, you know, the US was up, 17, 18%, and it was one of the most underperforming markets globally.
And that's
at those
right.
kind
as
of
long
levels.
as it just goes sideways, we're good.
Yeah, but if it starts to kind of fall and it starts to go down, that will have a topple effect on everything, and that will be bad news for us all.
And in terms of the US economy, if we get, you know, we might get tax cuts. We're expecting to get tax cuts coming through in the United States. But might we see a deteriorating jobs market? I mean, that's what some people talk about with the AI story, that maybe you get good growth, but the jobs market deteriorates. Our guest earlier had a different view, though. So what are you looking at from that sort of fundamental economic side?
So we're not seeing much in terms of the jobs market at the moment. I mean, actually what's interesting is you're seeing not much in terms of the postings. So actually there isn't much growth in the job market, but the actual downturn in the job market is not something that we've started to see come through. And when we talk about CEOs, to CEOs, they aren't actually talking in any kind of way about reallocating or thinking about jobs. So that is not an area that we think is a particular focus. But you're not seeing growth. You're not seeing a growth in postings. And that is interesting, actually, to Guy's point before, in terms of the actual growth in the market and how much of that growth is going to be driven by bottom-up. Again, what we would normally see is that kind of jobs and job creation. We're not really seeing that globally. So that is something really interesting and different to anything we've seen before.
Can I just get your take on what's happening in the UK this morning? ABF down by 10%.
Yeah.
Tesco, big main UK retailer, down by 4.5%. J. Sainsbury's is down by 4%. The consumer in the UK, and there's housing data out as well this morning from Halifax, which doesn't paint a particularly good picture as well. The UK consumer is really struggling at the moment, and it's not just the bottom quartile. The top quartile is also being impacted by tax rises, by what is happening, just in terms of there's a lot of kind of wealth targeting at the moment happening in the UK as well. How much of is there a message in this as to how important the consumer is and what you need to do to get the consumer going? It just feels like the UK at the moment is kind of stuck. I'm watching the US with the upper end of the consumer spectrum doing really well. And to your point, that's being supported by the stock market. It's not happening in the UK. Is there a message there for the rest of the world about kind of how important the consumer is and what the consumer message, how important it is to support the consumer at the moment?
No, I really do think that. I mean, as you said earlier, the 10,000 headline is being hidden because it's mining and energy dominated. When it comes to the consumer, the day-to-day is going to be driven by the consumer. And in the UK, there is consumer weakness. I think the Bank of England are going to have to take note of that. I think we expect them to take note of that. And hopefully that will reinvigorate things. I would say for a number of these stocks, and you see this particularly in the UK small cap, valuations do reflect that from a market perspective. Sure. But from a UK economy perspective, absolutely. We need to focus on the consumer. And what we've seen particularly in the US just shows exactly how important that is.
Is the BOE behind the curve? I mean, at least the Hawks. Is the central, given everything that Guy's just outlined, is this a central bank that is behind the curve?
I would like to see them move relatively quickly. I think they do need to. You know, I'm always a bit hesitant to say something quite as bold as behind the curve, but I think they need to move sooner rather than later. So I'm going to put it boldly and say, yes, I think they are.
But is this stagflation? This is what stagflation looks like, isn't it? We have an inflationary problem in the UK. You look at what is happening in the services, you look at what is happening with the labour market in certain there is inflation still, but there's also a slowing consumer. Is this a harbinger of what happens in America?
I don't think it is, because the America story is quite different in terms of the level of, you know, what makes up the consumer, the level of consumer strength, the investments, the amount of capital that they have. I don't think you can take what is happening or what is potentially happening in the UK and take it as a direct read across for the US. The US right now is a very different economy, both in terms of what it's built on, both in terms of, you know, where the wealth creation is coming from, and in some ways the kind of breadth of that K curve as well is very different. So I don't think you can take the UK into the US. But I do think from a UK perspective, getting it re-energised is going to be very important. So, yes, I think we should move on that.
Great to see you. Always a pleasure. Thank you very much for stopping by to see us. Helen Jewell, International CIO of Fundamental Equities, joining us from BlackRock. Core 6 looks like this. Defence stocks are having a very strong morning. BAE Systems, Leonardo, Renk, Rheinmetall, Saab dominating the top end of the market this morning. Rheinmetall is the standout story. You can see it there. Elsewhere, luxury's weaker. It's interesting that Schneider's rolling over a little bit. Nestlé's holding up in a market that is struggling this morning. Maybe that sort of quality defensive story maybe comes to the fore. Let's get the details of what else is happening and where we should be focusing our attention with Chloe Mellet.
Good morning, guys. So as you said, defence is having a really good morning. We've got green everywhere here, and that is after Trump said that he intended to really increase the US military budget. He wants a boost to annual defense spending of more than 50% for 2027, and said that that would be financed by revenue from tariffs. And we have seen Asian defense stocks move higher on the back of this, and we are also seeing very similar moves here in Europe. And in particular, we're seeing BAE Systems do really well this morning, up more than 6%. Moving on to recruiters, which are not having as good of a day, and that is after those three were cut to an underperform rating by Jefferies. The analysts have said that there will be cyclical problems as well as structural challenges, and that will really hurt the earnings for those companies moving forward in this year, after what's already been quite a tough 2025 for those names. And so we are seeing some big downward moves there, in particular for Adecco this morning. Moving on to Tesco, which is also in the red. Tesco has actually said that it expects profit to come at the top end of guidance for this year, but this was actually still below consensus. And then the sales for the third quarter and over Christmas was also below analyst estimates. And so there's a little bit of weakness there this morning. We're down about 4.8% for that supermarket. And finally, Saint-Gobain is also in the red this morning, down 1.7%. That is after UBS cut the recommendation to a sell rating for that construction company.
Chloe, thank you very much. Chloe Melly from our equities team with a host of movers on this Thursday morning. A bit distracted by this red headline that's come across the Bloomberg terminal this morning. ICE plans 22-hour trade for Europe, UK gas and power by February 23rd. That sounds like a not very long to adjust our workflow, but this is Intercontinental Exchange. Yes.
This is the opening trade.
Continuing trade.
Yeah,
it'll
maybe
be called.
That's what we're going to have to call it.
UK and European gas and electricity contracts will trade for 22 hours a day from February 23rd, seen as a major overhaul.
Stock market's going to do the same.
Then to your point, it'll all be the opening trade, 24 hours a day. Coming up on the programme, we check in on European defence stocks. Donald Trump demanding more US defence spending and demanding that America's big defence manufacturers don't send money back to investors. We will get into that next. This is Bloomberg. This is the opening trade. Let's check in on the European defence sector as it is rallying this morning. President Trump said he would request a more than 50% increase in next year's military budget to $1.5 trillion. Shares had tumbled earlier. This is over in the United States as President Trump had called for military contractors to cut dividends and buybacks. That was what we saw in the US session yesterday. The White House has since posted an executive order to that effect. Let's think about the US defence sector, also the European defence sector then, as they are rallying this morning. Michael Masika joins us, Senior Strategist for EMEA Markets, Macro Trends and Strategy. Michael, very good morning to you. So let's deal with it here and now. Strength in European defence right now. Is this because of the globally more tense environment we live in, and it's a continuation of last year's story and the start of this year? Or is this something specific about the US policy announcements that we saw yesterday that feeds in to Europe, do you think?
Well, I think it's a broader picture. The thing is, obviously, none of the European contractors are going to have like a contract or are going to benefit from any of what the US are doing. You know, like whatever they've done.
BAE Systems is basically a US prime. It's the top gainer. It has the biggest foot by a mile in terms of the US.
So you have some of that, but at the end of the day, you know how that administration is thinking and what they're doing. It's America's first, it's US companies first. So maybe they'll get some of that, but it's I don't think it would move the needle. What's important here is like the broader picture. More tensions, more geopolitical headlines coming out. A US administration that, you know, is kind of doing the unexpected kind of thing. And also at the same time, you have in Europe the European Union that needs to bulk up the defense spending. Germany is bulking the defense spending. And what we have here is investors now thinking that is going to accelerate. Because what we've seen last year is during the first half of the year, those defense companies rose like massively, and then it stalled completely for the second half. Even like there were like a lot of profit taking at the end of last year because people thought, you know, they're not going to deliver on their earnings. It's going to be slower than expected, and now that narrative has switched again. It's like it has to be fast.
I just wanted to check what the dividend yield is on BAE. Industrial gross yield, it says here, 1.66%. If you put dividends at risk, how important is the dividends return to shareholder part of owning a defence stock? Are you just interested in the top line, i.e. the top line's going to grow massively because defence stocks they're going to increase? Do I worry? Is it a capital appreciation story or a capital return story? Do I worry about the policy decisions that Trump is making on that front?
For European names, I don't think it matters.
Right.
The thing as well is, like you said, we are in a capital appreciation story. It's about growth, it's about spending, it's about top line and bottom line, earnings growth. more than it is about dividends and income. This is not an income story. Defense is not an income story.
Yeah. Is there a risk that investors get burnt because politics in Europe prevents additional spending because they're constrained?
That's the risk. That's the big risk because, like a lot of countries in Europe are really constrained. I mean, France, the UK, you name it, except for Germany, pretty much all European countries are really constrained.
House of Commons yesterday, was it yesterday or the day before? Question after question. Yes. When is the UK going to hit its defence spending? When are we going to hit the 3% target? When is it? And it's a struggle.
There was no clear answer.
No.
And there's a question mark about whether or not additional taxes will have to be put on the burden of consumers and businesses here in the UK to fund that additional defence spend. So the UK government needs to come up with an answer at some point, would be the critics' push on that, no doubt. And that ties into the broader theme around defence spending. Michael Masika, thank you very much indeed. Let's go to tech. The two kind of tie together. China is moving closer to approving imports of Nvidia's H200 chips. It's about national security, it's about defence. China is the world's largest semiconductor market, of course, and renewed access could support expectations that Nvidia's growth trajectory can be sustained. Really significant developments then. Let's bring in Debbie Wu, Bloomberg's tech editor in Taipei. Debbie, what do we know about this approval?
So China will approve some purchases of Nvidia's 200 chips as soon as first quarter, so the current quarter. And then this is for the select commercial use by private sector companies. And at the same time, though, because of national security concerns and also China's own self-sufficiency drive, the Nvidia's H200 chips will not be allowed in critical infrastructure for the military or for sensitive government agencies in principle. And if these organizations, units, they want to still want to use Nvidia's chips after Beijing approves the purchases of those chips, they will have to apply for approval, and these will be reviewed on a case-by-case basis.
Yes. OK, so we watch that closely for many reasons, Debbie. Sticking with the tech sector, but in memory chips, Samsung posting really impressive numbers because of this big hike that we've seen in pricing of memory chips.
Right. So Samsung's pretty good initial results indicate that the overall AI demand or for AI build-out remains quite resilient, or even, should I say, quite strong. And then its peers, SK Hynix and then Micron, actually both have indicated they have sold out more or less their entire offerings for this year, so 2026. And then Samsung's result again reinforced the indicator that overall AI demand remain quite strong.
OK, Debbie, thank you very much. Bloomberg's Debbie Wu with the latest on the tech sector. We started the week talking a lot about Venezuela, remember? We're going to do that once again. We're going to be speaking to Lee Robinson, CIO and founder of Altana Wealth, a hedge fund solely, well, it's been focused on Venezuela. What other opportunities might they see out there? And what are their expectations now around Venezuela? Being bondholders in Venezuela, do they expect to get all the money back? How many cents on the dollar? We'll get into that conversation next. This is Bloomberg.
Welcome back to the opening trade. We are 30 minutes into today's session. So down on the benchmark by 0.1%, but lift the hood and there's a lot more interest going on, particularly when it comes to defence stocks, and that is powering the gains coming through for the DAX, up 0.2%. Rheinmetall, one of the biggest gainers. BAE also gaining very strongly. The last time I looked, up about 6%, but that's not lifting the FTSE 100, dragged lower by the grocers and also some of the basic resources and mining stocks as well. Over in France, CAC currently off by 11 points. Guy.
Oil also dragging down the FTSE 100 this morning. That's certainly a factor to fold in. Let's talk about what the breakdown looks like in terms of the kind of the internals that we look at on a day-to-day basis. Breadth a little to the downside, 343 stocks lower. Volumes actually ticking a little bit higher today. It's a lot going on. It's interesting the volatility is as low as it is, and this market just feels choppy to me. There's a lot of churn, a lot of rotation happening below the surface. BAE Systems, Rheinmetall, Rolls-Royce, all trading strongly this morning. It doesn't surprise me that BAE Systems is the biggest beneficiary this morning. It probably has the biggest exposure into the United States. It is a major supplier to the DOW in Washington, and as a result of which it potentially could benefit from this increase in spending that Trump is talking about. Rheinmetall, though, is up by 3%. Rolls-Royce is up by 1%. So the defence names are certainly on the front foot. Where are you seeing weakness this morning? Shell potentially talking about a little bit of weakness in trading around oil. I wonder whether that persists into this year, or whether there's more opportunity within the oil space to make money. But that certainly is having an impact when it comes to what is happening with Shell. There's a stock-specific story. There's the kind of the broader what is happening in oil prices story. Schneider's also a little off this morning, which is interesting. Schneider, remember, is a big component supplier into the data center story, but it is fading this morning, down by 1.4%. But the real standout story to me this morning, aside from what we're seeing in defence names, is what is happening with UK retail grocers, what is happening on the high street with Primark and ABF. Real signals from the UK consumer about weakness, real signals for the Bank of England as to what is happening in terms of the way that the UK economy is evolving from here. Inflation versus weakness, kind of how is the UK going to manage this? Tesco, look at this, down by nearly 5% today after the Christmas period. The numbers do not make pretty reading, Anna.
Yeah, absolutely. Let's stick with the UK as we get up to date on some of the other news flow then, Guy, this morning. UK house prices, they dropped at the sharpest rate in almost 2.5 years in the month of December. That's according to data from Halifax. The report adds evidence that Chancellor of the Exchequer Rachel Reeves' budget in November deepened the housing market's troubles in 2025 after a stamp duty increase distorted demand earlier in the year. Over 1,000 companies in the United States have lined up to recoup their share of billions of dollars in duties paid so far since the introduction of the US tariff regime. This as the Supreme Court prepares to decide the fate of most of President Donald Trump's tariffs and that overall regime. The administration had collected approximately $133 billion in duties under the emergency authority as of December the 14th. And oil is moving a little higher this morning after the Trump administration said it plans to control future sales of Venezuelan crude and hold the proceeds in US accounts. The statement from the Energy Secretary Chris Wright is the clearest statement yet on Washington's strategy to control Venezuela's most valuable resource. And so, Tom, we learn a little bit every day this week, it seems, about the US and its intentions towards Venezuela.
Yeah, the pieces of the puzzle maybe coming together. Let's get more analysis and bring in Alaric Nightingale on that story. He leads our European oil trading team. Alaric, what do we know about the intentions of the Trump administration? Do we have clarity in terms of how they plan to purpose and use Venezuelan oil and whether or not they can actually do that in a practical sense in the medium term?
Thanks for having me on. So I think there are ways. I mean, there are barrels that are on the water now. They have seized probably more than 5 million barrels of cargo already, so that can be taken into US refineries. So in the short term, there is oil on the water that could be appropriated, I guess you could say, and the US refineries are adept at processing that stuff. So in the short term, yeah, they can. There are some barrels available to them if they do this. In the longer term, trying to sort of create a stable regime and environment for international oil companies to get back in there, that's a much bigger challenge. I don't think there's a great detail, but we've already seen the tanker seizures and the cargo seizures, so some of the answer is already kind of happening.
Alaric, what are Chinese refiners going to do? There is clearly consternation in China about what happens with the relationship with Venezuela. Do they have to buy barrels elsewhere? Are there similar barrels elsewhere that are available? Kind of as once again we see a rewiring of the global energy complex. How does this affect China? How does this affect Asia?
That's a great question. I mean, there are a lot of sanctioned barrels on the water in the world. Off the coast of Malaysia, there are millions of barrels just floating. We're in a market that is heavily oversupplied, and is moving into a heavier oversupply, particularly kind of in this quarter, in the first half of this year. So there is some kind of availability to them. That doesn't change the fact that they've got significant investments in Venezuela and will no doubt be frustrated by what's happened. So it's not like China isn't going to get the oil it needs. It clearly will, and there's plenty of barrels around. Russian barrels are still flowing. Iranian barrels, just the plain ordinary Middle East barrels. There's plenty of supply. If the prices work, the barrels move, and maybe they're less profitable than they were. But ultimately, there's always supply.
Right. Alaric, help us understand the sanctions story around Venezuela right now, because we understand that the US administration is looking to remove some of those sanctions. And yet yesterday we saw this incredibly dramatic story about chasing at least one empty vessel, but that had been accused of carrying sanctioned oil all the way across the Atlantic to the north of Scotland. So incredible developments on that front, and yet they're trying to remove the sanctions. They obviously wanted to stay in the Western Hemisphere and not go to Russia, not go to China. What's the story with the sanctions?
I think there is an element where we just need to wait and see exactly how it plays out and not be kind of too declarative about how it's all going to work. So some things are clear. Yes, they've got a blockade. That blockade has been in place for some time for these sanctioned vessels. But I think they probably also don't want to just completely gum up Venezuelan oil supply. So there's a tricky balancing act. Every time they grab a tanker that is leaving, they kind of remind everybody, on those ships and in the global market, that these barrels can't go where they would have gone, probably to China. I think they're trying to kind of strike a balance between keeping the oil flowing and stopping it flowing to kind of rival countries.
Yeah, keeping it flowing in one particular direction. Alaric, thank you very much. Thanks for the update. Bloomberg's Alaric Nightingale with the latest on the oil sector and as it relates to Venezuela. That's where we started this conversation. Let's stick with that. Bond investors in Venezuela have been hoping for debt restructuring. How likely is that to happen? And what would it mean for those who hold the bonds now? Joining us now is Lee Robinson, Altana Wealth CIO and founder. Altana Wealth, good morning to you, Lee. I understand has been investing in Venezuelan bonds. Give us an update on your exposure to Venezuelan bonds then, Lee, and what you're expecting in terms of a restructuring.
Well, we've been exposed for quite a while, and so our exposure has just increased in value, I guess, by 30% rather than particularly materially changed. What are we expecting? Restructuring was ready to go in middle of 2024. Rothschild had been appointed, the Paris Club was involved, and that was all dependent on the elections going smoothly in Venezuela. And of course, Maduro stole the elections, or allegedly stole the elections, and that all got on hold. So I think the restructuring is ready to go, and the pieces are in place. Now, what we were waiting for was obviously something to happen from the US, and as of 4 or 5 days ago, I think there was considerable doubt that the US would do anything more than perhaps a few targeted strikes on Venezuelan soil. But instead, they've removed Maduro without loss of life in a fairly bloodless coup d'etat, and there was some injuries, and the downside risk now on the bonds has disappeared. I mean, what could have been, Maduro still being in power as we head into the midterms in late 2026 in the US, these bonds would have traded down from 30 maybe to the low 20s. I mean, that scenario has gone away. And more importantly, if that scenario had happened, it might be like 4 or 5 years before we actually had a restructuring. And now the restructuring discussions and process will likely start this year. Okay. So you've now got a timeline and a limited downside, which helps the bonds.
Okay, let me just explore that a little further then, this limited downside that you described. So we have seen, the price of these bonds has jumped from sort of 20 cents on the dollar up to more than 40 cents on the dollar. So the market is with you in your sentiment that, prices are going higher. There's more expectation that you get more from these bonds. But I read a piece yesterday in other media talking about, don't forget Iraq, don't forget what happened there. Investors there got 10 cents on the dollar, and that they were drawing, the authors of that report were drawing a parallel here. How sure can you be that there is no downside?
You can never be sure, of course. There is 2 things to say. First of all, you can't look at it as 20 cents to 40 cents. There's, an average of about 80 points of interest on top of these bonds, right? So you're talking about 182, 184 on average for each of these bonds. Some of them worth 200 with past due interest. So 40 cents is still only 22 cents on the dollar, which is a very low recovery level for a sovereign. When you look at Argentina or something like that in Latin America. And secondly, a lot of new money for Venezuela is going to come from those previous bondholders. They're going to be asked to take a haircut on their bonds and put new money in. Well, you can't have it both ways. So I don't think that's the case. And I think we've also seen in recent years, since Iraq, the use of GDP warrants in Ukraine, oil warrants, etc. And so, yes, there is downside, but there's just a lot more material upside. And, this is something where Trump has made it very clear. Oil is going to flow to the US. Billions and billions, in fact, trillions of dollars are going to be made by US companies. So this is a country that can repay its debt. It doesn't have to rebuild its infrastructure that has been vastly destroyed by an American army as it was in Iraq. So just the comparisons are very cherry picking. I mean, if you turn around and said, well, what about Ukraine? There's 75 cents on the dollar. What about Argentina trading at 75 cents on the dollar? These are just cherry picking by people who want to get into the trade at lower prices.
Lee, good morning. What does fair value look like then for the sovereign debt of Venezuela? Is 75 a prospect? What would look too rich for you?
Well, with all these restructurings, if you don't do a big enough haircut on the bonds and you don't think the debt is sustainable, they trade at very low prices. So let's take two scenarios. A scenario where there's no haircut at all, and you get 1-for-1, 182 points. Well, they're not going to trade at par, are they? They're going to trade at 50 cents because people don't think that's sustainable. So, you end up with 80, 90. If you have a haircut of 50 points to 80, 90, and they trade at 80, 90% of that value because they think it's a realistic haircut, you end up the same level. So I think you end up somewhere in that range. You might get a better result if you get a combination of new debt and oil warrants, because people generally tend to like the oil warrants because they'll be linked to obviously future GDP growth, which when a country has gone from 500 billion of GDP to 80, because it's been mismanaged and shut down all its oil infrastructure, if it rebuilds that oil infrastructure, it will likely go back to 200 billion, 300 billion, 400 billion of GDP over 10, 15 years. So this is a bit of an anomaly as a country. It has iron ore, gold, oil exports in dollars going to US companies. So, recovery could be, very good on a 2-3 year view. It doesn't mean that they're going to trade at 70, 80 this year. Of course not. But, that's where I think you'll be sort of looking for the upside. And as I said, the downside is a lot less than the upside as it stands today.
Lee, are you seeing increased investor appetite? Are you seeing those within your space tapping on the shoulder saying, how do we make the same play that you've made? How much interest is there right now?
I think there's been renewed interest since midway through 2025. I mean, a whole number of new players have come in and bought positions, partly because emerging markets had a fantastic year last year and new money came in. And when new money came in, obviously it got deployed in all sorts of different names, such as Argentina, Suriname, etc., that were distressed. But of course, Venezuela, because it was the lowest priced other than Lebanon bond out there. Of late, there are new players who have come in this week, of course, because a lot of people were concerned that this was going to be, dead money for the next 4 or 5 years, and now there is a holistic plan from the White House to build new Venezuela with some urgency, as the Trump administration tends to act with urgency. Now, whether they make a mess of it, as they did with Iraq, or whether they do a good job, we will find out. But at the moment, there's a lot of optimism. It's happened right at the beginning of the year when there's new money coming into funds. And frankly, most emerging market bonds are trading, double or even treble the prices of Venezuela and PDVSA.
Lee,
so it makes it a bit of a no-brainer.
The Chinese invested a lot of money in Venezuela. And I'm wondering, how do Chinese claims on Venezuelan assets work in this process?
Well, the Paris Club, obviously is aware of the Chinese claims. A lot of these have been for oil, and China is a superpower. China will get repaid. You know, it may get repaid at a better deal than the bondholders, but it will certainly get something in line there. It's not going to get, and neither will Russia, by the way. They won't get zeroed out. I mean, they're legitimate claims. They'll be treated in the same way.
And how quickly do you think this process will unfold?
I mean, typically you would look at something between 9 and 18 months from starting point.
Okay.
So, you know, this is something where discussions will start in the next few months. The IMF has been for its first trip. I think it went to its first trip last year in 5 or 6 years. As I said earlier, Rothschilds were appointed to find out where all the debt holders were. So things are in place. You know, the US will likely provide some bridging loans, assuming that Delcy Rodriguez plays ball. Of course, it's got the oil collateral. So I think it will move quickly. And, you know, we all know that the Trump administration is a very urgent. It likes to do things quickly. Whether it does it well is another matter. But I think it will start reasonably soon. It's certainly an expectation. Okay. Discussions will start soon. Whether they drag on 9 or 18 months, your guess is as good as mine.
And Lee, are you looking at other geographies with this same kind of drama and story in mind?
I don't know about the same kind of drama, but the same kind of story. You know, clearly everyone's talking about Cuba, but I would infer that Ukraine. There's not a coincidence that the Trump administration was putting so much pressure on Ukraine as it was gathering its warships around Venezuela. I think the two are linked. I think that's clearly been discussed with the Russians. So I think you'll see a side deal in the next couple of months on Ukraine. And of course, the other big story that's not getting enough press is really the China property bonds that are all going through their restructurings pretty much from the middle of last year, and that'll go on until the middle of 27. There's about 40 names that are going through debt for debt and debt for equity swaps under US law, under US bonds, in a very similar situation. You know, very murky, very difficult to get the information on the ground, but trading, you know, 2 to 10 cents on the dollar, depending on the name, but under US law and going through restructurings that look very similar to a normal Chapter 11 restructuring in the US. So, you know, we're quite focused on that as our next big, you know, 3-4x trade.
Okay. Lee, thank you very much. Lee Robinson, CIO and founder of Altana Wealth, putting the focus, Tom, on emerging markets for us this morning.
OK, coming up, we're going to switch focus just momentarily. How much is the average luxury watch in the secondary market? And why are prices on the rise? The answers when we come back. This is Bloomberg.
Taylor Swift.
Now, before we the break, we asked you how much is the average luxury watch in the secondary market and why prices are on the rise. We'll give you the answer right now. $34,000, this is the number, $34,400. $34,400 in the secondary market. Prices in the secondary market then for luxury timepieces rising to the highest in more than 2 years. The Bloomberg Subdial Watch Index, which tracks the 50 most traded timepieces by transaction value, gained 8% just last year. And for the why, prices have been fueled in part by demand for dress watches favoured by celebrities like Taylor Swift, Timothée Chalamet, Guy Johnson. Gen Z collectors in particular are seeking elegance and uniqueness, apparently, over the once dominant blocky steel sports models. And that is all Guy. As you can see, we've got a shot of Guy's wrist right there, or Timothée Chalamet's. Guy.
Square watches. We've done round watches, now we're doing square watches. So presumably this is good news for the likes of Cartier, Jaeger-LeCoultre.
Kind of squoval.
These kinds, yeah, but smaller, not these big. It's the Taylor Swift economy. Taylor Swift economy is
so small. Val and I were just laughing at that neither of us are wearing.
But you two are timeless, so that's
neither of us are wearing
so smooth
any watches. There we go. Let's leave this to go as well.
Okay, let's move on to Donald Trump, taking a pot shot at Wall Street yesterday when it comes to the housing story on social media, saying people live in homes, not corporations. Basically, the president is proposing a ban that institutional investors will not be able to buy single-family homes. That sent shares of assets managers like Blackstone tumbling. At one point yesterday, Blackstone was down by, I don't know, let's call it 9%. Joining us now for more on this story is Bloomberg's Jill Desis. Presumably this is ahead of the midterms. I'm assuming that that's the kind of the catalyst for this.
Yes, Guy, I think that that's a pretty fair assumption here, right? Look, I think the affordability crisis has really vexed Donald Trump and the Republicans, certainly over the last several months. I mean, they've got to be looking at some of those polling numbers out of Gallup in December, suggesting that it's just 36% of voters were approving of Donald Trump's performance. This is something that the Democrats ran on pretty successfully in some key races last November. Now you've got Donald Trump administration looking ahead toward this year's midterms, whether or not they can hold on to Congress. And affordability is something that repeatedly comes up. You've got, Donald Trump himself has obviously been incredibly defensive on this issue. He's even, gotten to the point where he's called some of the Democratic criticisms a hoax. Whether he can actually overcome that, this is, it's potentially a measure that he's taking to try to overcome some of those issues. Now, the one thing that I have to caution here is we've talked to several analysts about whether this particular move would actually do much to ease the issue. A lot of them are saying that really, when it comes to housing, it's more of a supply issue than anything else. And really, when you're looking at those institutional investors, I know that they've been a favored punching bag over the last decade or so, but they actually own proportionally a pretty small percentage of the housing stock in the grand scheme of things. So would this actually do too much? I'm not sure, but I mean, certainly, I think you can look at some of the political motivations there as a catalyst for the Trump administration.
Yeah, important context. Jill Desis, thank you very much indeed with the update. The day book today, just briefly, before we get to Val Titel, we've got some ECB data in terms of, for the ECB at least, CPI expectations. That's at 9 a.m. UK time. A little bit more on jobless claims, some more data there. Let's bring in Valerie Titel right now. We'll also be hearing from the Treasury Secretary. As we talk about jobless claims later today, we had ADP numbers yesterday. Just get up to speed on what the data is telling us as we look ahead, of course, to non-farm payrolls today.
Yeah, a bit of a muddled picture, at least on the employment front at the moment. We did have ADP coming in weaker than expected, but then if you looked at the ISM report, the employment subcomponent actually entered into expansion for the first time since May 2025. So that was kind of the good news on the labor market headed into NFP on Friday. Now, we didn't necessarily see a big market reaction to the data yesterday, but we did see a decent bond rally. There was a decent bull flattening happening around the world yesterday. And this is happening despite the first 7 days of January being the biggest bond issuance we've ever seen on a global basis. More than 270 billion has been issued so far in January from corporates and from sovereigns. We even hit a record here in Europe yesterday. 57 billion was issued, 57 billion euros. It does seem to have been absorbed by the market quite well, which stands into contrast, if you guys remember what happened back in September of last year when this issuance surged again. We did see the market kind of not necessarily absorb it to the extent that we hoped that it could. And this is important because there is going to be a lot of debt issued this year. The AI race and all the debt that entails and all this fiscal spending as well.
So that's fine then. We don't have to worry about supply. That's what I take from Valerie.
At the beginning of the year.
At the beginning of the year.
When there's lots of money coming in.
What date is it? 8th of January. We're not worrying about supply. OK, that made me feel better. Valerie, thank you very much. Bloomberg's Valerie Titel, of course. Sticking with the macro themes, don't miss our conversation with Fed Governor Stephen Myron. Will be with the Bloomberg surveillance programme a little bit later on today. So don't miss that interview. We're also going to keep the focus on tech. This is Bloomberg.